Welcome to Real Estate Developer Discussions with Katie Kim. And this is a special episode of our Beyond the Build series where we talk not just dirt, deals, and development, we talk power moves. And today we're pulling back the curtain on what really drives your financial success as a developer. You've heard the buzzwords capital stack, preferred return, developer fee, promote, but if you don't truly understand where your dollars live in the deal and when you get paid and when you're flying blind. So I brought in the big guns, my financial truth teller and resident CFO, Cheryl Heller of Pier 1 Consulting, and she is joining me again for the brutal, honest conversations we're calling Show Me the Money, how your capital stack and fees really work. If you've ever asked those questions, where do I fit in the waterfall? How can I pay myself before the back end payday? How do I protect my upside without starving the business today? Then this episode is your roadmap. We're giving you plain English definitions, real world examples, and the exact questions you should be asking before you sign your next term sheet. Get ready. This is the money math that separates the deal chasers from the true developers. Welcome, Cheryl. So glad to have you back.
Thank you, Katie. I'm excited to be here. This is a great topic.
It is. And we were starting to talk about this on some of our prior episodes. And we said, wait a second, we've got to make this its own episode. It needs its own defined segment and session. So glad to have you back on. And really, let's start by 101, right? Let's define the capital stack.
Sure.
What is
okay. So going back to the basics, the capital stack is basically the order of priority in which people get paid back in the deal, both for their original investment and their profits. It's also layers of how much risk versus how, where your risk falls in the order, right? So your senior debt, which is top priority. So this is usually your bank loan, your construction loan. This is usually the lowest risk, but it's also the lowest return. It's going to get paid first before anybody else sees a dime. And it's going to just have a stated interest rate. And no matter how great the project is, the senior debt holder gets the interest rate and nothing more. Then you may have something called mezzanine debt or mezz debt. And that's really what is filling the gap between what the senior debt holder is willing to lend you and how much equity you have in the deal. So usually this is a less secured debt for the lender. It's a little bit higher interest rate. It's a little bit higher risk, and they get paid after the senior debt or senior lender, but before any of the equity gets paid back. And then you go into the preferred equity. So this is where equity investors, and they may have negotiated a right to get paid first or a preferred amount. So sometimes you can see preferred equity would have a guaranteed minimum percentage, right? So maybe a fixed annual return of 8% before any of the common equity holders get paid back. So it's got more risk than the debt because there's a chance that you get nothing, but it's got that greater upside. And then common equity is really sort of at the bottom of the stack. This is where you as a developer is likely going to reside. And any equity partners that you bring in that don't have that preference right. So you get paid last if there's any money left. However, there's also the biggest upside because you get to share in the outsized returns if a project does really well.
Yeah. So a real quick reality check there as she's starting to list those things. And there are a lot of other aspects that come into a capital stack at different sections. And so we really want to get to the basics first. And those are really those four common revenue sources that are going in. So if kind of a heads up, if you're a developer and you're only in the common equity, you're dead last in line, right? So everybody, and as Cheryl is naming those off, that's kind of that order of priority of payment or what we'll get into soon here called the Waterfall, which if that's the case and the project is underperforming, you could walk away with nothing after years of work and hard times. And that's where a lot of people get burned when they go into their development the first time is they think that's the only way. Like I'll put myself last and get everything done. We're going to start to talk about different things in that capital stack and go deeper. There are additional things. Yes. And I want to point that out because as you all know, if you've listened to this podcast for any length of time, I love economic economic incentives, and we definitely put those in the capital stack, but we're starting with the basics here. So they would go into the capital stack if you're using them appropriately, but what we're focusing on is those main basics here. So a lot of time, another word I want to say is that mezz debt. Some people call those like bridge loans or construction, mezz kind of, think of it as like it's a temporary, kind of a fill the gap, temporary type of a solution. And when we talk about a keyword that I often hear gets confused as well is that preferred equity. And Cheryl did a great job, is those are the equity investors that are coming into your deal before that common equity. And a lot of times when people say preferred, they think that they have that guaranteed payment. And I want to caution everybody when they're listening to it in the terms is that that's not always the case. They get maybe the first standpoint in that waterfall, but they're not guaranteed just by using preferred. So a couple things I just want to make sure as we step into it. So let's look at an example transition flow here, or transaction flow, if you will, of how that could be set up.
Yep. Okay. So say you have a project where the total cost is 10 million, right? So you have, brought in your capital stack to come up to that $10 million. You sell the project for $13 million. Okay, so your senior debt is going to get paid off first. So you borrowed $6 million at a 6% interest rate, right? So we're assuming simple interest, so $300,000 of interest. So you pay the senior loan back $6.3 million, right? Then in this example, you don't have any mezz debt. Then you have your preferred equity, and they put in $2 million. So you're going to give them back because you have more money, right? If you only had $6.3 million, your senior debt would get paid off, and that would be it. To your example, Katie, where the preferred equity is not guaranteed just because it's preferred. In this situation, you have enough money to pay the preferred equity back. So they get their $2 million back, plus they get their 8% preferred interest for the 2 years that they were in the deal. So that's another $320,000. So $2,320,000 is what your preferred equity partners get back. And then the common equity, so your developer, your other investors, so they also put in $2 million, right? So they're going to now get their $2 million back because you have, after you've paid the senior debt and after you've paid your preferred equity, you've got about 4.4 million to return in the deal. And this is where you start to see the leverage that you can get as a developer with common equity. So you take back the $2 million that was the original equity from the common slice. And now you've got 2.4 million left over. So what do you do with that? That's your profit to your common equity holders. And so in this example, they were able to make back all the money they invested plus 100% more. They over 100% profit on the deal. So this is really one of those great examples of where, as a developer, you can really have a lucrative return.
Love it. Okay, so and if you guys need a visual, I would say watch this episode on YouTube. We'll put the numbers on the screen as Cheryl's going through it. So I want to talk high level math to summarize that. So the total project cost 10 million, right? Sales proceeds 13 million. So we profited, or we got a profit, received a profit of 3 million. Now, when we look at the capital stack, again, the capital stack, we're talking about costs. So how did we get to that 10 million? Well, 6 million of it was the senior loan. 2 million was preferred equity, or what we nickname is pref, right? A lot of times we shorten that up. And then 2 million was common equity, which was, let's just say it's divided 50-50 of a developer and an investor at that point. Okay. So, and in the details of the pref, that 2 million part of that capital stack, we have an 8% simple pref for 2 years. So we're looking at paying that back again as a preference as we're paying out if there's money, right? So that's how the stack works, right? So we have that 10 million, 6 loan, 2 pref equity, 2 common equity, which is developer 1 million, investor 1 million, and then we have a 3 million of profit. So now when we start to look at exiting this, right? And exiting out of this. And the reason, and I want to step into that waterfall here in a second, but the reason I want to talk about that is even one question we have this past week in the Development Academy, the Developers Advantage call, we were talking about how am I setting up the deal? And really it talks about you always want to set up the deal for what can the deal afford to give? What does the deal need? And how are you planning to exit the deal? And what are those options? So as we start to look through that, I want to put those questions and those thoughts in your head as we start to dig into the waterfall. So the deal needed $10 million of capital to go into it to make it work. It was able to handle $6 million of debt service on there. And then we had to fill that $4 million with really no debt service cost while it was happening. But that gets then, I would say, rewarded or compensated upon the exit. So let's look at the waterfall next. Can we go there?
Okay. So your waterfall would be that like out of that 3 million profit, you would first pay the interest for your senior debt, right? And then you pay your 8% pref return. And then the amount that's left is what goes to your common shareholders at that point. So that's how you kind of waterfall the numbers out.
Awesome.
The other interesting variable that can happen here, because I think, with us just saying that the common equity holders gets all the profit, could be a little unrealistic, right? Your preferred return holders, they want their preferred return of 8%, but they also want to share in the upside. So then you might have a term that's like the LP-GP split, or the GP promote, or the other term for it is the GP carry or carried interest. And so that is the part where that sort of 2.4 million of excess profit doesn't just go to your common equity holders. It would get then split between your preferred holders and your common equity holders, right? So if there's a 70-30 split, after everybody gets paid back the initial capital and gets paid back their preferred return, then you take whatever's left and you would split that 70% to the LPs, 30% to the GPs. And that's how the gain would be distributed, or whatever, 80-20, 70-30, 60-40, whatever was agreed on in the initial docs.
Yeah. And I want to pause there for a second. Is like, that is when you talk about the preferred equity in, that 8% is kind of to get them in the door, if you will, to say like, yes, okay, I'm gonna get that as long as everything goes well, right? And here's my upside, right? And here's that upside. So again, what does the project need? What can it afford? And what's the exit in there? So
absolutely. A couple of things just to be aware of. We are doing simple math here, right? And I know, Katie, you talked about this simple pref of 8%. Well, you have to really look at the documents and make sure you understand what's going on, because you could have a simple preferred return and a simple interest, or you could have compound preferred return or compound interest. And so what that means is the longer the deal goes on, the more you're going to pay interest on the interest, or you're going to pay that preference, that 8% preference on the 8% preference. And so you have to make sure you understand if you're in a simple framework or if you have compounding framework. And so we tried to simplify the example for sake of this discussion, but there's definitely a lot going on there. The other thing, there's a whole bunch of other complicating factors, right, that come in. And depending on how sophisticated your preferred investors are, your preferred equity holders, they could have catch-up clauses, they could have other hurdles. Sometimes that, we were talking about the GP LP split. Sometimes it's like the first X amount of profit is split 50-50. And then after that, it's split 70-30. And so you have to make sure, especially when you're doing your underwriting, that you understand what all those terms are so that you're getting it all through your model in the right way.
Yeah. And those are great points to point out. So I appreciate that, because one of the first deals we did was such a low interest rate return that we were giving to the investors, because the deal just couldn't afford it. And it was a 4.8% but we compounded it. And we knew that like we had a 5-year time frame to get these investors bought out and out of the deal before that really started to become a financial burden. Now that's a risk we all knew going in, that this is the time frame we got to look. And we actually even built the offering where we had a guaranteed buyout amount because we had done that math. And so I love, as you're saying, go through the deal. And this is, I think the analogy we had is like, I shared, or maybe our last episode, but it was like development's like a coloring page, and you have a design of what you're going to do on the page, but yet you can color anywhere on the page as long as you stay on the page. And that page is your SEC regulations, your laws, all those things. And that's what we're talking about here. So if your brain's starting to like get overwhelmed, go ahead, pause, go back. Let's do the reps, get this back in your head. But this is really to stay simple on those initial terms, but yet show you how you can really step into that creativity. And I always like to start with, let's just start with the 80-20. Like, let's run the numbers on a project, 80-20. Can we bring in 80% investor funds or like a common equity kind of a scenario here, and then 80% institutional or bank funds? And can it work? And if not, then we start pulling the levers of, okay, do I need a preferred equity in here? Do I need a different mezz debt? Do I need economic incentives? And you start to like pull those levers till you get to the project stack of where you need. Because if you can't attract the investors with what they're looking for to bring them into the deal, you're not going to get investors. Deal's not going to go through. If you can't give the banks what they're looking for, deal's not going to go through, right? If you can't get paid what it's worth to you to take the risk, deal doesn't go through. So we have to look at it as, here's the canvas, and then start pulling the levers to make sure everybody gets what they want, or somewhat what they want, but like what they need to at least say yes to the deal itself.
Yep, absolutely.
I love that. Okay. So again, going back to some of that simple math, and we can kind of take that home. So if I'm looking at the 10 million project cost, 13 million capital stack, when we start to talk about that waterfall, we're paying the 6 million to the bank first. We're paying I was going to say 300, but let's say 320K of the pref. That's that 8% interest for the 2 years on the 2 million, right? So those are like waterfall one option, then the second step. So then we're looking out of that 13 million. We've paid out, rounding errors, or rounding numbers, we'll just say 6.3 million. We have 6.7 million remaining. And then, as you mentioned, we're returning capital. So we're returning that $2 million of capital to the pref first, right? So now we have that, what is that? 6.7 minus the 2.3. That we have about 4.38 remaining. Then after that preferred equity is down, we go to common equity and return the common equity of the 2 million, which is the developer 1 million and the common equity investor 1 million. So 4.38 minus 2 million is 2.38 million. And then the remaining is the profit that now you kind of decide how's that getting split. And you mentioned 70-30, 50-50, 80-20. That's how you set up your deals. So say, simple math, but keep it going with that, is that you're going to split that 2.38 million of profit 50-50 with your developer and your investors, right? And the bank's out, right? The bank just gets their interest, they got their loan paid. So that means that your profit sharing, that 2.38 divided by 2, 1.19 million. So to translate that as what the developer will take home is they get their 1 million back. That's the original investment. They get 1.19 million in profits. So the total back is 2.19. And
well, are you saying the common equity? The common equity gets 2.19 total, or sorry, their 2 million investment plus the 1.19. That 1.19 of profit gets split between the developer and the common investor.
Great catch on that. Yes. So, because the pref would have that 50% more than likely in that deal. Yep.
Yeah.
So then that would be, the half of the 1.19. Correct. Okay. This is why we always try and write down math when we do it, not in the head. All right. So how can you start to look at this and say, what can we tweak? Or you're adding, actually, let's take a step back. A lot of people use the buzzword, and we were talking about this before, a promote, right? So can you explain what is a promote? Like, and give me some lingo that people say, oh, the promotes, 2 and 20 or blah, blah, blah. Like,
right. So I also dabble in the private equity space, right? In addition to real estate. And so in private equity, you'll hear it referred to, like you said, 2 and 20. And so, and this is very similar, and we haven't gotten into all of the developer fees that you could do, but from a private equity standpoint, you might have, you raise your fund and then you go invest in companies. And the 2 is your 2% management fee that you get on an annual basis out of the fund. And so that's like your asset management fee from a developer standpoint, right? You would get an asset management fee on an annual basis to manage the project. And then the 20 is your promote, your carried interest. It's got a lot of different words. But that means that you, out of the profits, you then get 20% of the profits. Now, in this case, in our example where the preferred was 2 million and the common was 2 million, it's fairly even there. So you would say, well, why isn't the turn split fairly even? Usually in the private equity space, the investors are investing a much larger portion than the GP in the private equity firm. And so that allows the GP to get an outsized return if the companies that they put in their portfolio perform well. So similarly here, you might find a space where, your preferred investors bring a lot more to the table than you as a developer are able to bring. And so by you getting that promote, that carried interest percent, that allows you to profit in an outsized way from your hard work. So it's not directly related to how much money you can come to the deal with. It's more related to the total profit of the deal. And so that's really another piece where you want to understand as you're modeling, because as you were mentioning, Katie, the investors need to make sure that they're getting the kind of return on their dollar invested that they want to get. And they're likely matching that up with other projects that they're looking at and saying, which project is going to get me the best return for the most manageable amount of risk, right? And so they're weighing primarily those 2 items, their return on investment and the risk they're taking. And so you might have to give up more of that profit, and reduce your promote in order to get investors in the deal. Or if it's a pretty low risk project, the investors might be willing to take a lower percentage of that profit so that you as the GP can get a higher percentage of the profit. So, everything's negotiable, right? And I think that's what we have to remember around here, that these numbers that we're calling out, they're merely just for an example purpose. And, you have to make sure that you understand what's in your particular deal, because every deal is different.
Absolutely. And I love how you put that. It's example purposes. Somebody might look at like 8%. I wouldn't get out of bed for that. And I just gave you an example that we just did 4.8%, right? And they may looking at 10 and 12, and knowing what those numbers mean is so critical. And how, when you're talking about like simple versus compounding, there are sometimes I read pitch decks and they may be saying simple interest. And then I read their investment documents and they have compounding in there. And so to me, the investment docs are the guidance that, so if I now sign a doc that says compounding and yet your pitch deck said simple, you kind of can get caught there. And so I love how you're breaking that down. And so we talk about that waterfall, and we'll put some of that example in a show notes so you guys can download it as well. And side note, if you did catch what Cheryl just said, she does do private equity lending. So definitely make sure, if you are interested in more details on that, check the show notes, and we'll tell you more at the end of the show how to reach out to Cheryl and find out all those details on that. So there are multiple ways in development to make money. And as you just mentioned, private lending, being able to lend to some of these projects, investing in some of these projects, putting some of these projects together. And a lot of times I get asked as a developer, like, how do you make money on a deal? right? Like that's usually the biggest question. And it really will depend on your skill set that you bring in and what you can do in the development. Now, I've been very blessed. I have a real estate license. I know how to do a construction project. So I can run the construction. I can oversee that. I can oversee the development, put the deal together, property management, which I always love somebody else doing. And then asset management, which is, managing investors. And we'll dig into those different sources that you can do. But a lot of times you'll want a team with somebody that plays those different roles. And more often than not, in different projects, we team with other people to do those roles. So we don't have to do everything, but we have the skill set and the capability to watch over all of them, provide input, and really be a good team player in that side. So in talking about the paycheck that developers get, if you will, through those fees, you can have different fees with what you're coming to the table with the service you're doing. So a lot of times they'll say acquisition fee, right? Which is paid when you close on the property. So I've secured the property. Now that's the acquisition, right? The developer fee, which is paid over that course of construction and overseeing the process, making sure you said what you said was going to happen happens. And I've had people, as a side note, I've had investors come and be like, why are we paying you to watch over the project? Like, we could all watch over the project. I'm like, okay, so you want all these investors that's not their role. They have no expertise to watch over a construction project. And I said, there's no way I would even do this deal. I wouldn't even do it, which is why who you invest with matters, right? Is if I'm investing with somebody and it's their first deal, you better have some really strong partners with you that have a resume that are helping you out and mentoring and pushing that deal. Otherwise, that risk is way higher, right?
Yeah.
And then the last one we'll talk about here, it's the more of those common fees, is that asset management. And that's paid while you manage the asset post-construction or after it's like stabilized. You're managing, the investors' relations, the tax filing, all those different, asset management tasks that you have to do because you have a business, you have an LLC, you have a joint partnership, like whatever it is, you have an entity that you now have to maintain and communicate with, right? So the dilemma is always, how do you take a healthy fee now so you can pay the bills and keep you focused on that project, which may reduce the project's short-term returns, or do you lower that fee, keep the lights on and have a bigger equity upside later, right?
Yeah. And I think it's always a balance, right? Like if you can't afford to keep your business running without taking in a fee, then you're putting yourself and the whole project at risk, right? And so, and I think, investors understand that, right? Like you're working day to day to get all of this stuff done. If you're, doing the deal, you're managing the development, like you can't just wait to the end and hope for a good payday, right? Hope is not a strategy. And so you want to make sure that you're taking some of your money out during the course of the project, whether that's through the acquisition fee, the developer fee, or the asset management fee, so that you are able to keep the project going. Now, I think, the big thing here is whatever you take out, that impacts the project, right? And so that means that if you think your project is going to cost you $1 million and you want to take a 10% acquisition fee, well, you better figure out a way to get $1.1 million in funding, right? So,
you're funding for your fee at that point, right? And it happens. Yeah.
Yeah. Yeah. And also, a lot of times, what you might see is the GPs who would normally get the acquisition fee, they might choose to reinvest the acquisition fee to buy into the LP side of the deal. And that, as an investor, feels great because you know that the team that's bringing you the deal is putting their own skin in the game, right? Like whether they're coming up with cash out of pocket or they're reinvesting their acquisition fee, either way, it's cash that they won't have in their bank account. And so, if they believe in the deal, they will likely put some of that back into the deal.
Yeah. And I love that because a lot of times when we're doing developer for fee for a client, I never assume that they're going to ask us to invest in the deal. Again, because they're having us put together the project for them. But a lot of times if they do, we have a rule that we'll invest up to 50% of our fee. Because again, we want to be building on solid foundation and keeping the lights on and all that good stuff. But if you're working with somebody and they don't want to invest in your project, that to me is a really telling sign. Because I would say anytime I've been asked to invest in one of my clients' project, I absolutely do because I believe in it, right? I'm working on it. We're building it to be really good. And that's where there's a benefit of working with somebody that can also bring some of that capital stack on that equity side together with their fee or accrue in, which sometimes we'll even see that. And I don't want to go down too much of a rabbit hole of like sweat equity, because that's a whole different, like that can be a Vent Fest podcast almost. Like people getting burned with like, oh, they put their fee in, but yet then they didn't do what they said they were going to do. And how do you accrue into that equity investment from that sweat equity standpoint? So don't want to go too far down.
And one super important point about this, and this is not tax advice and speak to your own tax preparer, but if you take your acquisition fee and you reinvest it in the deal, that doesn't get you out of paying taxes on receiving that acquisition fee in the year that you received it. And so you have to make sure that you're accounting for that, because when you get to the end of the year, you should be receiving a 1099 from the entity for that acquisition fee. And if your tax preparer puts that in your tax return and you don't have the cash to pay the taxes on that, you're going to be in trouble.
Surprise. Yes. And Patsy, my one of my CPAs, is gonna love the fact, if she ever listens to this episode, which I'm sure she will be like, yes, Cheryl, yes. So we have, even when we do the construction, we have a end of the year notes with every asset that we manage, and we put the sweat equity in, we put the fees in, and we actually put that in our pitch pack as one of our exhibits and disclosures, because we want to be transparent, right? We want everybody to know who's getting paid, how are they getting paid, where's that money coming from? And I think that's a best practice, because if it looks like you're, just volunteering to do this development, then I question, okay, well, if another project comes along that is now paying you or is better returns for you, are you going to ditch this project, right?
That's a great point.
And so, ask the questions, and especially as you start to look into these capital stacks. And I'm sure as those people are listening to this episode, they're thinking, oh yeah, if I would have asked this question when I was evaluating this deal, I would have seen that. I would have known that. And there's many more questions we can dig into, but I love how you talk about, like, especially if it's a fee. We're also talking to our realtors here now that put their commission in as equity into the deal. You still need to be saying, this is what I received because I received that value that is taxable. Make sure you contact your CPA. We're not giving tax advice. That's the whole disclosure, right? Every unique situation, right? So that really affects your position in that capital stack, whether it is an accrued or sweat equity, or you're putting money in, and that you can rely on that, on the back end, or, if you come in on that common equity and you have multiple layers. So make sure you're a sound, healthy developer and you're building on solid foundation, because that can really be the difference between making money or barely breaking even, right? And kind of falling apart, if you will. All right. So love that. That was great. And it was very high level, but it was impactful. So if you're listening to this and you think like, wow, that was a lot, listen again. Go to our YouTube for this episode. We'll put the link in all the show notes and all the channels. And if you think this was of value, please make sure to share it with somebody that you're working with or is just getting started in the development career and or business and putting together investment opportunities. Would love that. And I want to ask you, Cheryl, what are some, as we wrap up here, what are some takeaway or action steps that we can leave our audience with today?
Yeah. So I think just laying out the capital stack for the next deal or the deal that you're working on, or even take one, even if you're not ready to invest in the next deal right now, go take something off of, like Crexi or LoopNet and make up a capital stack. So you get used to the reps, right? So that you're thinking that way. And then think about your personal financial needs. What is your compensation plan for this project? What fees are you taking? When are you taking them? How they're going to get paid? Do you have to raise extra money for them? Are they, built into the returns of the deal? Making sure that that's all modeled out correctly in your underwriting, and understanding what equity upside you can have in the deal. And then the last thing that I would say, and I, recommend this anytime we're doing a financial forecast, you have to run the worst case scenarios. So what happens if the project takes longer than you think it's going to take? What happens if it costs more than you thought it was going to cost? What happens if you can't sell it for what you thought you were going to be able to sell it for? There's so many unknowns that are just outside of our control that you have to have strategies on how to mitigate those risks. And the only way that you're going to do that is if you think about it up front and you plan for it up front so that you can make those quick judgments in the moment if any of those things start to happen.
I love it. I love it. When I think of the risk mitigation strategy, my analogy, because I love analogies, are always the flight attendant. Like when you start to board that plane, your exits are here, 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 and here. And when you're running those worst case, I like to start the deal with that. Like I want to break the deal before we start to make it big and sexy, right? And that gives me that power pressure point to say, like, we got to lease up by this date. We got to do this. And that drives everything else. It drives my marketing. It drives the promotion. Who am I bringing on the team? And then that's actually what I show my banker too. And so I think I maybe mentioned on the last one where he's like, you're one of the only developers that are like showing me this, like, oh my gosh, doom and gloom. And everybody else is like, we're going to make tons of money. It's like, well, we want to make tons of money, but I also want to know that I can keep my house, right? Like all the things. And so really appreciate you stressing that worst case. And even if you're going with the best case, my recommendation is never show 100% occupancy, right? Because you're always going to have a tenant moving out, transition, something to go on, and contingency, right? So love this topic. And I want to thank you for coming on again and sharing your expertise and your knowledge. So where can people contact you and reach out and learn more about what you're doing, what you offer for clients? Where are all the ways they can find you?
Yeah, the easiest place to find me, my website is pillar1cfo.com. It's Pillarone CFO. And my email is Cheryl@pillar1cfo.com.
Awesome. Thank you very much, Cheryl. Appreciate it. And thank you so much. So, okay, guys, that was a masterclass, right? So I know your brains are buzzing right now, and that's good. That means you're starting to see what is actually taking place to build a development business that pays you first, not last. So here's your challenge, a little bit of homework, if you will. Don't let this stay theoretical. Pull out your next deal, or even better yet, pull out a past one. As Cheryl mentioned, go back through and do the reps. And I want you to walk through those 3 steps Cheryl gave you, right? So map your capital stack, 1. 2, define your personal compensation plan. And then 3, stress test it with that bad case scenario. So this episode wasn't about theory. This episode really is about control and about clarity, about protecting the person who's risking the most in the deal, you. And if you want a visual to make this real, we've got your back. Head to the show notes to download the 1-page capital stack and developer fee map. It'll change the way you look at every term sheet from now on. Thanks to Cheryl for breaking it down for us with so much clarity. And also thank you for tuning in. If this has helped you, please share it with another developer, builder, or investor who needs to hear it. We're not just about building projects, we're building power. Keep it going. Let's go. Hey friend, before you go, I want to say this. If real estate development has been on your heart or on your mind, we've built lanes to help you walk it out wherever you're starting from. Just exploring? Start out with our free live masterclass. Ready to do the reps and build the strategy? Join the Developer 101 Bootcamp. Already active and need to level up? Step into the Real Estate Development Academy. You don't have to figure this out alone. We can teach you, we guide you, and we walk with you. So head over to katiekim.com and book a call with our team today, and let's figure out the best first or next step for you. You're not behind, you're not too late, and you're definitely not too early. You're right on time. Let's go. The information in this podcast is for educational and informational purposes only. It is not legal advice. It's not financial advice. It's not investment advice. Real estate development, like any investment, carries risk. Before you make decisions, you should always consult a licensed professional, your attorney, your CPA, or your financial advisor, to name a few, to make sure you're making the right choice for your situation. I'm here to share insights and strategy, but you're responsible for your own decisions, and each situation is unique. So make sure you contact your professional team to give you your specific guidance for your specific case, as each real estate development's different and unique and has its own challenges and opportunities.